Today, what we're going to focus on is historical statement analysis. I said this in the beginning of the semester, which is the past doesn't always tell us what's going to happen in the future. However, the past will inform the way we look at companies in the future. So there are two sets of historical statements we will look at during this class. One is called an ROIC tree, and the second is a CFI analysis. All right, this will also be an upcoming homework assignment that you will have to basically repeat what we do, but we'll be doing this as part of our group projects work as well. So let's start out with this information, which somehow got. All right, so this is a ROIC tree for the company McDonald's historically. We'll start with this to do our ROIC analysis. So the idea is we want to explain, and what you can see here is this is a company's after-tax ROIC, operating ROIC, and it's based on end-of-year data. Okay, that's what the EOY ROIC stands for. Now, when we do this analysis, we do it today, we're just going to care about the beginning and the end of this 5-year period of time. It's about eventually the training wheels are going to come off, and I'm also going to hold you responsible for each of the years, okay? But for just getting started, we're just going to look at the beginning and the end of the period. But you got to care about how you got there as well. All right, so the point of this analysis is we want to explain the change in the ROIC over time. There are three things, and always three things, that will explain a company's change in ROIC. The first is the tax rate. The second is the operating margin, or EBIT, or operating income divided by revenue margin. And the third is the productivity, invested capital divided by sales. So when I talk about first level of analysis, these are the three things that we are going to be analyzing to explain the changes in the ROIC. It is also important that you use numbers, because on your assignment, I don't care how many words you write, if you don't use numbers, you still get a 0. So, must use numbers when you explain changes in ROIC. You can't just be vague. So, again, EOY ROIC is current year no plat, divided by current year invested capital. So this is slightly different than the midterm, but again, this is the way that you're going to see it formatted in the model that we're going to build. So in 2010, McDonald's ROIC was, look over here, it's scrunched, 21.8%, and in 2014, it fell to 18.9%. And that was a 13.6% decline in their after-tax ROIC. Okay? So, why did it decline? First level of analysis. Let's look at the first culprit. What happened with the tax rate? In 2010, McDonald's taxes were paid at a rate of 29.3%. 2014, they paid 35.5% in taxes. The percentage change below that is a 5-year percentage change. So the tax rate, or taxes they paid, went up by 20.9%. So just thinking about that, if I pay more in taxes, that's going to hurt my ROIC. So one of the reasons why McDonald's ROIC went down end of year over the 5 years is because the tax rate went up. They're now paying more in taxes. Pay 21% more in taxes than they used to. Okay? But if we strip out the taxes, we're then left with what's called the pre-tax ROIC, which is what I'll call the operating performance of the business, right? And it's this operating performance of the business, which is basically selling the burgers, right? So basically, the pre-tax ROIC went from 30.9% to 29.2%. So not only did the ROIC worsen because they're paying more in taxes, but the underlying business of McDonald's actually also got a little bit worse during this 5-year point in time. Now, when we look at drivers 2 and 3, what drives ROIC? Margin times productivity equals ROIC, right? So what is margin? Margin was profit divided by sales. And we said if we multiply that by sales over investment, we get ROIC. The difference here in the tree is we're going to use a reciprocal. The reciprocal is investment divided by sales. Reason we're doing this is because in the years I've been working with companies, companies think in terms of sales. They don't think in terms of investment. And so one of the drivers of ROIC is P over S, profit over sales, but the other is S over I. And people don't think in terms of sales divided by investment. They think about investment divided by sales. How much did I spend to drive sales? That's the way they think about things. How much did I sell to make a profit? How much profit do I make when I sell things? How much EPS do I make when I sell things? Everything is sales driven at a company. So just to make our analysis straightforward, everything on this ROIC tree is based on sales. Okay, so in this case, second driver is margin, profit divided by sales. That's operating margin. And it's either EBIT or operating income divided by sales or revenue. Okay, the way to read this is in 2010, McDonald's operating margin was 31%. In 2014, it was 29%. That was a 6.7% decline in operating margin. But more importantly, they're making 2 cents per dollar less selling food than they did 5 years ago. That is obviously going to hurt their ROIC. They now have 2 of the 3 drivers are hurting their ROIC. They're paying more in taxes, and it's costing them more to sell their same products. The third driver is productivity, invested capital divided by sales. Here's a way to think about this one. In 2010, to generate $1 of sales, McDonald's invested $1 in capital. In 2014, to sell $1 of sales, McDonald's invested 99 cents in capital. Which one's better? In 2010, to generate $1 of sales, McDonald's had to spend $1. In 2014, to generate $1 of sales, McDonald's had to spend 99 cents. Which one's better? The second one. So the third driver of ROIC was favorable. That McDonald's is spending 1 cent per dollar less in invested capital, working capital, property, plant, equipment, etc., than they did 5 years ago to sell the same amount of stuff. So when I think about what explained the drop in ROIC, higher taxes, lower margins, slightly offset by the improvement in productivity, but that wasn't enough to offset the decline in the margins and the drop in the tax rate. That's your first level of analysis for McDonald's, using numbers throughout. The second level of analysis basically now goes over here to the right side of the tree. What drives operating margin? It's 3 things from the income statement. Operating income, or EBIT, is a function of gross margin minus SG&A minus depreciation equals operating income or operating margin. So those are the 3 things off the income statement. So let's look at that second level of analysis. Gross margin went from 45.3 to 61.4. And SG&A went from 9 to 26.5. Except, kind of interestingly, I know I said don't look at the intervening years, but in the intervening years they went dramatically different between 11 and 12. And this is not common, which is actually why I left the McDonald's example in here, because this is an anomaly, but every now and then we run into anomalies. So this is not really comparable for a gross margin in SG&A because something really weird happened at McDonald's between 2011 and 2012. All right? So either something fundamentally changed about their business, which I don't think is the case, or accountants reclassified costs, which is, I think, exactly what happened. All right? And that's the problem, is that when they moved around costs between SG&A and cost of goods sold, they changed the way that they were reporting their statements. But the problem when they did that is that it now makes McDonald's much harder to analyze when they did the jump. So we really can't, all right? Because this isn't an apple and an orange. It's like an apple and a watermelon, or a pineapple. Like it's a big jump to be seen between these two statements. Okay, they're not even very similar to each other, just dramatically different. So the point of the story here is I really can't do a 5-year comparison on gross margin and SG&A, but I can do a 3-year comparison. Okay, the last 3 years are like versus like. So in the last 3 years, what I can notice is gross margin went from about 61.7 to 61.4, so it's pretty flat. But the SG&A went from 25.1 to 26.5. So I think what's really happening at McDonald's here is McDonald's is spending more on SG&A to try and get sales into the stores relative to the revenue that they're spending. That's the increase in SG&A. Depreciation as a percentage of sales was flat across all 5 years from about 5.3 to 6, so we're up 0.07 cents. But essentially, the real hit to their operating margin was the increase in SG&A. That's what it looks like for McDonald's. On the second level of analysis, the other part is what happened to the productivity. Well, that's the balance sheet. Invested capital divided by sales is a function of 3 things. It's working capital, it's PP&E, and it's goodwill and intangibles. Add those 3 together. You just did the midterm. Get invested capital. So these are the 3 drivers of invested capital. So those 3 bottom right columns, if you add them up, you basically get invested capital divided by sales. All right? So let's look at the first one, working capital. Working capital to sales went from -2 cents to 0. Now, what does it mean to have a negative working capital?
More liabilities and assets.
Yeah. So either they're in financial distress or they're just choosing to use their size to leverage against their vendors. My guess is they're probably doing the latter, but in either case, they have more liabilities than assets. All right? So here's the key. If you go from -2 cents to 0, does that mean you're spending more or you're spending less? If you have -2 cents of working capital and then you have 0 5 years later, are you spending more or are you taking away from working capital? I mean, if it delta increased by 2, -2 to 0, you're spending more. So McDonald's productivity is actually worsening. Even though it's 0, it used to be -2 cents, now it's 0. It means we're paying off some of those liabilities. Okay, so that actually hurts their productivity. All right, PP&E to sales is the next one. Spending on property, plant, and equipment as a percentage of sales. In 2010, they spent 91.6 cents. In 2014, they spent 89.5 cents. So if you really think about it, McDonald's benefited by spending less on the buildings themselves, the buildings, the equipment inside. In fact, if you really think about it, the two kind of offset each other. Spent 2 cents more on the working capital, but they saved about 2 cents on PP&E. All right? And the third one is spending on goodwill and intangibles. These are the purchase premiums primarily for buying other companies or buying intellectual property. So goodwill and intangibles went from 10.7 cents to 10 cents. So again, spending less on goodwill and intangibles, that helped invested capital to sales. By the way, that final metric is a good way to judge the benefits of an acquisition. Because if you spend money on an acquisition, goodwill is fixed. And if I do it as a percentage of revenue, if I have a fixed amount of acquisition expenditure and then I drive more sales, then intangibles as a percentage of sales go down. So if I really want to measure the impact of synergies on an acquisition, it's intangibles divided by sales. Because that's what I would expect. I'd expect more sales out of the spend that I get, a fixed amount of spend. So it's another way to judge when a company is buying somebody else, I'd expect this number to go down over time. Now the other way it could go down over time is that the accounts impair all the goodwill. So I could also have it go down because I just write off a bunch of stuff. But generally, if you're not writing off a bunch of stuff, it's another way to measure the productivity of an acquisition. Okay? So, or if you see a big jump in this number, that the fact that they did an acquisition. And it doesn't look like McDonald's really did any big acquisitions during this period of time. So here's the point. What really changed in their productivity was a slight improvement in intangibles, an improvement in PP&E, which was offset by the extra spending in working capital. All right, so On your next assignment, this is what you would be writing up. And you would be using all the numbers along the way, because without those numbers, you won't get any credit for the assignment. All right, your chance to practice. During the same period of time, this is Chipotle. This is pre-E. coli Chipotle, back in the good old days. Okay, so I'll give you a couple minutes. This is not for a grade right here. It will soon be on your assignment, so now's your good chance to practice. You're welcome to talk to somebody next to you if you want to, but the point is, look at the data from Chipotle, see if you can kind of walk through it just like I did, and practice yourself. So I'll give you a couple minutes to think about Chipotle. What's changing about their ROIC and why? 2 levels of analysis. Question? Do you have like some other buckets? What I'm trying to do is, if you have that problem, call Ruben and see if there's just something that can help you troubleshoot with that. Because if you're the only one having it, it sounds more like a count problems and a terminal problem. Worst case scenario, they have a count. Subtitles? No, if somebody was doing it, right? But I don't think. If somebody gives me a suggestion, how to do it, maybe I don't have to grade it, but if you can tell me, what would consider it? All right, another minute or so, and then we're going to start going through Chipotle. That's just the percentage, it's like the effective tax rate. It's what percentage of taxes they're paying of their profit. As opposed to the statutory rate, which is the, the listed rate. So this one's what they're actually paying. All right, let's, in the interest of time, try and go through Chipotle. So, anybody want to try and start here? Again, we're just trying to explain right now, just the beginning and the end. We're ignoring the middle right now. Yeah, go ahead.
The tax rate went down from 38.1% to 37.6% over the 5-year period, which helped their ROIC.
Okay, so that was one of the factors that helped the ROIC, which, by the way, doesn't hurt to say that the ROIC originally went from
43.0 to 65.
Yeah. So, by the way, just remember, McDonald's and Chipotle are actually peers compete at the same time, where McDonald's is kind of struggling a little going down, Chipotle is skyrocketing. Okay, but nonetheless, tax rate definitely helped them. All right. By the way, if we take out tax rate, what about pre-tax? Did the pre-tax for Chipotle get better?
Yes.
Okay. So the pre-tax also helped Chipotle. So it really wasn't a tax story as much as it was a pre-tax story. So it says the actual performance of Chipotle went much better because pre-tax ROIC went from, a little louder?
43% to 65%.
Yeah, 43 to 65. Okay, great. So now let's go down and look at the second and third culprits. Was it the operating margin or was it the invested capital to sales that drove the pre-tax ROIC higher? Which of the two was it? Or was it both? Yeah.
The operating margin rose by about 1.6% over 5 years.
Okay, from
2010 to 2014.
no, what numbers?
Oh,
Sorry, just keep. It's just good practice. I want to make sure you guys are successful here.
From 0.157 to 0.173.
Yeah, exactly. So obviously they got an improvement in their operating margin, which also was helped them with their pre-tax ROIC. And now what about the productivity?
It went down, so the percentage of invested capital to sales went down, which means that they're getting more sales for the same capital.
Exactly. So they're getting much more, that's what we call productivity or efficiency. They're getting, as exactly like you said, they're getting more sales for the same capital. So that's a big benefit. And specifically the financial benefit was that they went from spending 36 cents, 36.5 cents to 26.4 cents to sell the same amount of product. Okay, so essentially they got almost 10 cents of improvement in productivity on their balance sheet. Okay, so unlike McDonald's, actually Chipotle was firing on all cylinders. It got a little bit benefit of taxes, got better margins, and it got a better balance sheet while growing very, very rapidly. This is why these were the good old days for Chipotle, and if you did well in their stock, this is why you did well in their stock. Okay, now second level down. What was behind the improvement of margins for Chipotle? Was it the gross margin? Was it the SG&A? Was it the depreciation? Yeah.
Most of it was the depreciation.
Because?
They're spending less on like repairing equipment and that kind of stuff.
And the numbers were? Sorry, just trying to be helpful with the numbers.
3.8%, 0.038 to 0.027.
Okay. So improvement in depreciation. Be careful because on these pages, I did put the 5-year percentage change. And you'll look at the percentage change, you'll see a giant percentage change for the decline depreciation. But if you think about the magnitude, a change in a small number is not as impactful as a change in a big number. So just be careful about these percentage changes. Because even though the magnitude of the change in depreciation looks high, the percentage looks high, it wasn't as impactful as some of those other numbers as well. So just as you're going through this analysis. So the depreciation is really more to help you identify changes in direction. Think of it that way. Okay. All right. What about their gross margin? Did that help them? 30.4 to 29.9? That was a half a cent, right? They got a half a cent from gross margin. SG&A went from 11 to 10. So they got 1 penny out of SG&A. So there's a penny and a half there. And depreciation, as she pointed out, went from 3.8 to 2.7. They got another penny out of depreciation. So if you really think about where the 2 cents come from, it came from all three. And again, sales cures a lot of ills. Because remember, their sales were growing very dramatically during this period of time. Now, typically, when you grow sales, you spend a lot of money to grow sales. We saw their productivity improve. So now we go down to the balance sheet. Working capital, PP&E, goodwill, and intangibles. What was behind the big improvement in invested capital to sales for Chipotle? What's the data say for them? Yep.
Their PP&E to sales decreased 10 cents from 36.9 to 26.9.
And which of those three was the, so there's the PP&E, sorry, is the one that used PP&E.
PP&E to sales.
Yeah. So it's the PP&E to sales, which was the big improvement. Which again, you would be surprised that you think, well, that's where they're spending in order to grow the stores. But if you remember, they were like In-N-Out Burger. Like the stores would open and then there'd just be lines. And there'd be lines 24/7. So essentially, that was a big advantage to them. It didn't take much for them to get a lot of sales out of their new franchises as they were opening up. And it was a very, very good time to be a Chipotle shareholder. All right. So looking across these statements, Chipotle, as I said, improved its, I'm now summarizing, but improved its after-tax ROIC dramatically. It got benefits by paying slightly less in taxes. It had a 2% increase in operating margin, and it improved its productivity, primarily because its PP&E to sales went down, and it improved its margin because it got better gross margin at lower SG&As.
That just means that they had more sales per store, right?
And exactly, and they were getting a lot of sales per store, and more importantly, they were getting those sales per store pretty quickly. Like they didn't seem to have a huge ramp-up period, because you'd expect that the PP&E to sales would probably drop a little as they were growing for some companies. Wasn't happening at Chipotle. Okay? So, I'm going to give you one more company. This one, unfortunately, you're going to have to look on the screen because I didn't put it in the lecture note. But last semester, we looked at a company called Parker Hannifin. And Parker Hannifin, based in Cleveland, Ohio, basically makes component parts mostly for the aerospace industry, airline and aerospace. And so a lot of their clients are people like Boeing, Airbus, etc. Okay, so they don't make the planes, they make the parts, right? But here's the point. We'll start out with their first level of analysis. Again, I don't really care what you do. I just want to understand what's going on with your ROIC. So what can we say about Parker Hannifin? $16 billion parts manufacturer primarily based in Cleveland, Ohio. End of your ROIC. Went from, you see the screen?
15.3 to 16.6.
Actually, no, the after-tax one, 10.2 to 10.4. But what you can say is what he just said, the pre-tax ROIC went from 15.3 to 16.6. So their pre-tax performance improved. But the challenge Parker had in that same 5-year period was so did their tax rate. The tax rate went from 33.3 to 37.7. So in a way, the improvement in the business was offset by the additional taxes that they paid as a business. Everybody see that? So they got a slight improvement in after-tax ROIC, but not really much because a lot of it went to the tax man. Yes, sir.
In our explanations, are we going to have to figure out why the taxes increased or decreased?
For this assignment, I don't care about the why today. Later, I will. And the difference is when you do your group project, which you'll have 7 people to work a month on, then I'll expect you to have done a little bit more digging into some of these numbers than the superficial. But right now, as what I call it, training wheels, I just want you to understand structurally how these statements work. So taxes go up, ROIC goes down. Invested capital sales goes down, ROIC goes up. You got to be able to understand the puzzle before you take a step back to look at your mosaic. But good question. Other questions? All right, so what's driving pre-tax? Was it the margin or was it the productivity for Parker Hannifin? Why did the pre-tax go from 15.3 to 16.6? Was it the margin or was it the invested capital?
It's because their margin improved from 9.1 to 13.2.
Yeah, that 44% in operating margin was everything. That's why it went up. Because invested capital sales, if it goes from 59.7 to 79.2, that's not good. They're spending a whole lot more money on invested capital. They're spending 33% more in invested capital to sales. So basically, they improve their margin by a lot of spend on something. Okay, we're not sure what they spend it on yet. We'll get that in the next level down. But basically, a lot of that margin improvement was offset. Don't get me wrong, they still did better with the margin improvement net, which helped their pre-tax ROIC. Okay, so let's go to the second level analysis. Let's work backwards for once. Why did the invested capital to sales get worse? Was it working capital? Was it PP&E? Or was it intangibles? Yeah, clearly it was intangibles, which went from 33 cents per dollar to 52.6 cents per dollar. Matter of fact, you can see when did the intangibles really jump? Look at the intermediate years. Sometime in 17, they did a big acquisition. So again, I know they did a big acquisition. I may not know who they did, but now I should probably go find out. Okay? Because this is the difference when we're doing your final group project presentations in class, because I'm going to be sitting where you are. You're going to be standing where I am. You're going to have the data behind me. I'm going to see this gigantic jump in goodwill, and I'm going to ask the same question that's on your minds. Gee, I wonder who they bought. The difference is you're going to be graded on your answer. Okay? Because you should have known this yourself as something that's obvious. See, if you got Chipotle and there's no goodwill and intangibles, I'm not going to ask you who they bought because they didn't buy anybody. So that's what I'm saying. Like, you'll start to, the more familiar you get with these things, it'll highlight some of the analytics you'll probably even want to do. Because this is something that could be on the minds of the analysts. Why'd the productivity go down? This is a company I'm starting to study. Oh, they did a big acquisition. Why'd they buy it? What's going on with that acquisition? Right? So that obviously was the big drag on invested capital, because working capital 13 to 13.7, and that kind of hurt them a little bit. And PP&E to sales went from 13.8 to 13. That kind of offset the working capital, so it was all acquisition. Now, what helped their margin? Why'd the operating margin go up? Well, gross margin went from 25.5 to 28. SG&A went from 13.8 to 11.6, so both of those benefited them. And depreciation went from 2.5 to 3.3, which hurt them, but not nearly as much as the gross margin and the SG&A helping. Interestingly, if you do look at a 5-year trend, most of that gross margin SG&A improvement occurred in 17 and 18. So it's probably related to that acquisition. They probably bought a higher margin business, shifted the mix of their products, if I had to guess, just by looking at this data. Right? Because basically after they did the big spend on goodwill is when the margins really started to rocket. Okay, so it's probably they acquired a margin improving business, but they spent a lot of money to do it. So that would be one of the questions, which is that going to continue? You know, this is what I mean by setting us up for the valuations that we'll eventually do. Okay, that's called the ROIC tree analysis. Yes?
So you want SG&A or SGA to decrease?
From an ROIC perspective, yes. And the flip side is, if I spend more money in SG&A, I spend more money on R&D or marketing, what would I hope would happen? Not just sales to go up, but price to go up. So I'd expect my gross margin to hopefully go up as well. Okay, so I want sales to go up, but I also want my margin to go up. Because if I'm going to spend more on things that will, drive the business, I also hope that you pay a premium. Okay, so, because if you don't, then sales really have to go up. If my margins are going down while I'm spending more, that's just a tougher business to run, right? But as I said, some combination of these factors are what we're going to start to understand, but if nothing else, we want to start with the mechanics. So this is the first statement. This is called the ROIC tree, and these are the things you have to analyze. As I said, three things for every company: tax rate, margin, productivity. Then, what drives the margin? 3 things off the income statement: gross margin, SG&A, depreciation. What drives the productivity? 3 things on the balance sheet: spending on working capital, PP&E, goodwill. That's the analytics. Doesn't even matter who it is. You don't even need to know the companies to do this analysis. All right, here's the second analysis you're going to do. I'll go back to our lecture note. Back to McDonald's. It's a CFI analysis. Okay, you now understand CFI, cash flow available to investors, 5 historical years. What I've added to this chart is a column called total. Total is just that. It just sums the 5 years. Okay? For our purposes, with training wheels, we're just going to look at the total column today. Right? Eventually, you got to care about the 5 years as well, but for today, I'm just going to start with the total column. There are 4 sections of CFI, as you just learned. What is happening with free cash flow? Got to explain that. That's where we start. What's the operating section? The ones. Section 2, non-operating. What's happening in the non-operating section? Because that's going to drive us from the operating and non-operating to get us to our CFI. Once we have our CFI, what do we do with it? 3, what happened to the debt? 4, what happened to the equity? That is the analysis you do for the CFI. You always talk through those 4 sections, and you start with the free cash flow. In fact, I'll be even more specific. Free cash flow is telling for how you will do the analysis. If a company has positive free cash flow, Then the rest of your analysis, where'd the money go? If I have positive free cash flow, it means I generated more than I spent. What did I do with it? Did I put it in the bank in excess cash? Did I use it to pay off the debt? Did I use it to give money to the shareholders? If the free cash flow is negative, then the rest of my analysis, where'd it come from? Did I rob my piggy bank? Did I have to borrow more debt? Did I have to issue more stock? So the key to free cash flow is it kind of tells you, even though it's the same structured analysis, what you're going to be looking for. Give you an example. Headline this morning in the Wall Street Journal, GE is predicted to have negative cash flow for 2019. Now, investors reacted negatively to that, but here's the first thing we know just in the context of the statement. If you have negative cash flow, that means you got to go borrow money. And what we know about GE right now is GE's not doing well. So it's probably not the best of times to go out in the market and try and borrow money. They're going to get taken advantage of, pay higher rates, and have dilutive amounts if it's share issues. So that's the point. That's one of the reasons why investors reacted negatively to that headline about GE. It also could have been unexpected, but even if it was expected, it's still going to be bad for GE because now's not the time for them to go be issuing a lot of debt. So let's go back to the context of McDonald's. So how do I analyze McDonald's? I'll start with the total. McDonald's free cash flow was approximately $24.2 billion before goodwill and $23.9 billion after goodwill over the 5 years. Now, how did they generate almost $24 billion worth of free cash flow? Well, gross cash flow is cash from the income statement, about $35.5 billion, cash coming from the income statement. They reinvested into the balance sheet, gross investment for working capital and CapEx, $11.2 billion, which meant after reinvesting in the balance sheet, they had free cash flow of about $24.2 billion, and that represented a 31.7% reinvestment rate. If you remember about a month ago, we said if you take the amount reinvested as a percentage of your profit, that's the reinvestment rate. So they had about a 32% 32% reinvestment rate, which means they had theoretically 68% of cash available to pay out. That's the theoretical payout rate. Okay. What did they do with the cash? Well, they spent about $300 million on acquisition premiums. So they didn't really do a lot on acquisitions. So what they really do with the $24 billion? Let's go to the non-operating section. The first thing you're always going to look for in the non-operating section is what's going on with excess cash. In the case of McDonald's, excess cash actually went up by $188 million. So they generated $24 billion of cash, more than they spent, and they only put $200 million in the bank. So obviously that cash went somewhere. Okay, and that's what we're going to see on the CFI, because they also added $1 billion of cash to pay out by selling off some non-operating assets, which led to 24.757 of cash that they distributed. Where did it go? Let's go to section 3. Debt. They obviously had some debt because they paid interest of $1.7 billion. That was interest expense. That's a payout to the bondholders and the banks. But here's what's interesting. Then McDonald's, that negative, borrowed $4 billion worth of new debt. In fact, $4.4 billion of new debt. Did they need to do that? This was a midterm exam question last semester, midterm 2. With this number, did McDonald's need to borrow the debt, yes or no, and why? And you can actually answer that with certainty. Did McDonald's need to borrow that debt? The answer is clearly no. Why can we say it's clearly no? Because I got $24 billion worth of cash on hand. If I generate $24 billion more cash than I spend, I clearly don't need to borrow $4 more billion worth of debt on top of it. So what I'm saying is this was discretionary. The debt issue of McDonald's was clearly discretionary. It wasn't necessary. They weren't using it to fund an acquisition. They weren't using it to fund expansion. They were obviously using it for something else. We're going to come back to this. So let's go to section 4, equity. McDonald's paid $14 billion to dividends and shareholders over 5 years. McDonald's bought back approximately $14 billion worth of share repurchase. What's 14 plus 14? McDonald's basically gave their shareholders $28 billion of cash over the last 5 years. Right? Cool. How much cash do McDonald's have available to give them? 25. How do I give you 28 if I only have 25? Yeah, borrow 4. There you go. That's exactly why McDonald's borrowed the money. I don't blame them for that. We went through an all-time low of interest rates and free money, so big corporations took advantage of cheap debt and they used it to buy back their shares. Why not pump the shares a little higher with higher EPS and higher share price? And oh, by the way, my bonus is tied to growth in EPS. Help myself along the way, and I have some stock options. I can cash them in at a higher price. So, and if the banks are dumb enough to give me 0% APR for the next 18 months, why not take advantage of that? Yes, sir.
Where do you see distributions to shareholders?
It's called share repurchase. That share repurchase is going to be the change. If you remember, we talked about on our CFI, we looked at how much stock was being repurchased, the treasury stock. That's based on the change in treasury stock over the 5 years. I rounded up to 14. 13 points. 13.6, I rounded up to 14. No, and then I added the 14 billion of dividends on top of that. Look 2 lines up. They get 14.2 of dividends, they get 13.6 of share repurchase. Add those two together, that's about 28 billion in cash directly in the hands of the shareholders. And so what I'm just saying is, and I'm kind of rounding off here, but by proxy, that's why they borrowed the debt. Because I still got to pay $1 billion something of interest, but I really had the $3 billion debt to basically fund the extra share repurchase. So I'm not saying, it's not making a judgment on it, but I'm explaining what they did. And I get a much clearer understanding of what's happening in the business here.
What about the share issue and other adjustments to equity?
Well, they did do some shares issues over time, and the other adjustments, that's just crazy accountants doing crazy shit. I don't even know what you guys do in there anymore. You lose me. These are the AOCI off-balance sheet adjustments. And there's a lot of them these days. These are the adjustments you're making in the balance sheet that don't hit the income statement that are, in my opinion, it's where the bodies get buried. Because nobody looks over there. Right? So I'm just telling you, this is where I'll get on the soapbox in the next couple weeks because I don't like that. If you remember your accounting, there's 4 statements. There's the income statement, there's the balance sheet, there's the statement of change in cash flow, and then the 4th statement is statement of change in shareholders' equity. And what I don't like that accountants do now is that when I did accounting a long time ago, it was a simpler time, basically everything that changed between the balance sheet was explained by the income statement. But now there's this 4th statement called the statement of change in equity, where you can actually make changes to the equity that never flow through the income statement. And those are other adjustments to equity. And God knows what they are, all right? Because you really have to look in that statement to figure out what they are, and it's very vague, okay? And increasingly, investors know this. But unfortunately, so do managers. And that's what I'm telling you is a lot of stuff starts to flow through this AOCI adjustment, adjusted other comprehensive income. It's a big catch-all for black hole. Like you're doing stuff and you don't know what it is. And that's the other thing. We're income statement focused and it's not on the income statement, so you don't even know it's hitting you. So I don't even know what it is. But when I see it's big, it gets me upset. Okay? Because it means they're trying to pull something on me. Like if it's really an adjustment, flow it through the income statement. Don't just flow it through the balance sheet. Okay? Now this could be a write-off of something. It could be, I don't even know what they throw in there. But you guys are going to get paid a lot of money when you graduate very soon to figure out how to stick stuff in there. The accounting firms, the big 4, are very good at that. Okay, and you will get paid a lot of money and make big bonuses for helping companies do that. Make my life very frustrating. So I'll just be a crotchety old man. Right? But anyways, back to the originally scheduled programming. So for McDonald's, that was McDonald's. Look at Chipotle. I'll give you a couple of minutes. Look at Chipotle's CFI. Tell me what you think. All right. So, what was Chipotle's free cash flow? 968. What was Chipotle's reinvestment rate?
40%.
So they're reinvesting about half of their cash flow, and they still have 968 million left after the 5 years. How much did they spend on goodwill and intangibles? So what can we say about acquisitions? They didn't really do any. Okay, so Chipotle is all about organic growth. We already know that by looking at their statements at the time. What happened to the non-operating section? What they do with the 968 million? Yeah.
They put basically half of it in excess cash.
How much?
$436 million.
Okay, and what did they do with the rest of it?
They put $397 million in increasing their operating assets.
Some other non-operating asset. We don't know what it is.
So they're not-
And then how much CFI was left to distribute?
139.7.
Yeah, so exactly. So they didn't distribute much. So the 139 million distributed over 5 years, how much went to the debt holders? Pretty much $4 million. They paid off what little debt they had. They got a clean balance sheet. They don't really have any debt. They didn't pay any interest. They're all equity. They're making so much money they didn't need any debt, because they were basically funding all their growth, and they still had 50% of their cash flow left over. I mean, this is about as good as it gets from a financial story. As I said, people love Chipotle stock a few years ago. Okay. Then what happened on the equity side? They issued some shares and they purchased some shares. Okay. So here's the deal. I don't know for sure, but I'm going to speculate on this because a lot of companies will start to do this the last few years. But basically, shareholders get very nervous when companies start issuing a lot of stock options or restricted shares to employees because it's very dilutive. And under FASB reporting requirements, increasingly you can't just issue them and not tell the shareholders anymore. So I think what a lot of big companies have been starting to do is they'll buy back an amount of shares that are somewhat equivalent to what they're giving the employees. So they're kind of inoculating shareholders for too much dilution. And I think that's probably what Chipotle was doing, is that they were buying back shares because their share price was sky high. And they didn't need to buy back their stock, but the shares were probably purchased at a high price to basically offset the shares that they were giving to their employees. Either stock options are being cashed in and or restricted shares that were being sold at a discount to reward their employees. In fact, you love that as an undergrad because that's how you could work at Google or Facebook or any of those .comers and become millionaires pretty quick, because it wasn't about the salaries they paid you, it was about the option grants you get when the stock price was flying up. But the flip side is, to some degree, Google or Facebook would actually rebuy those shares in the marketplace, not just issuing shares over shares over shares for the employees, because eventually the shareholders are going to get diluted. So in a way, they're kind of paying cash for the shares, but then distributing them to you. So again, a lot of companies are doing that. I'm not saying it's exactly what Chipotle did, but if I had to guess, it's likely one of the things they were probably doing, because otherwise they really have a lot of money left to buy back the shares. All right. So again, that's Chipotle. So last but not least, I want you to go back to a more complicated company, Parker Hannifin. So here is their CFI. And I'm going to blow this up a little bit. Try and fit it onto one screen. So what can we say about Parker? Well, where do we start? Free cash flow, $1,740.7 over 5 years. What was their reinvestment rate? 29%. Did they spend a lot on acquisitions? They did. When did they spend on acquisitions? Why shouldn't that surprise us? Remember that? That was the same year of the big jump in the intangibles. Well, we know because now we know that they did some acquisition, which was a $4 billion increase in goodwill during 2017. Yes, sir. Do they have annotated sheets like what?
For example, we're looking at this now and we're like, oh, there's the draft. There's where they had a good.
Oh, well, I'll tell you, one of the other cool features of Bloomberg that Bloomberg did not mention is if you go to FA, or pretty much any one of the data points in Bloomberg, and you click on a number, it drills down and shows you what the number is based on. And what's really nice is if you go to FA, it'll show you where on the 10K or 10Q they got it from. And it'll actually pull up the PDF. And so that's the other reason why I like Bloomberg is that it's very good about data validation. Now, they'll make mistakes like everybody else made mistakes, but it's harder for them to make mistakes because when you click on the number, you can actually see the source. So that's a very nice feature of Bloomberg. But remember, these statements don't come from Bloomberg. These are the rearranged statements we're doing in the class. Okay? But nonetheless, we can go look at the M&A stuff, and I can quickly find from their 10K or in the EVT section, like a transcript from a conference call. We can go figure out what it is. But let's continue on. Non-operating. They went from 1.7 to 3.3 of CFI. What happened here in this non-operating section? Yeah.
Well, they took money out of the banks.
Yeah, they basically raided the piggy bank for $950 million. Okay, and they sold some assets and had a non-operating gain. So they turned $1.7 billion into 3.3. Now, they can't keep raiding the piggy bank forever, so free cash flow is more sustainable than non-operating cash flow, but nonetheless, they had 3.3 to distribute. How did they distribute it? Look at the debt. That's interest expense. That's paying off the retirement liabilities for their employees. What about this? They took on some debt. Now, if you look at when they took it on basically at the time of the acquisition. But practically, did they need to borrow it? No. Over the 5 years, no. Over the acquisition, yes. Why? Let's look at the equity side. How much do they pay in dividends? And what did they buy back in stock? What is 3 and 1/6? About 4.5, 4.5, 4.6. 3.3 here. So here's the thing. If they didn't buy back all the stock, they could have afforded the acquisition. Because they bought back all the stock, they needed the debt to do the acquisition. So really, they needed the debt to buy back the stock. Potato, potato. Questions?
Is there a reason why the share repurchase is especially high, like column D?
See, now you're starting to think like an equity analyst. So part of this analysis is to actually start developing questions. Because that's the point. Is there a reason why they did it this way? Is there a reason they made this acquisition? Did it change your margin substantially over time? Will that continue? So as we go through this analysis, it actually starts generating more questions and information insight about the firm going forward. That's why we're doing it. You won't always get answers. You'll actually get more questions, and that's okay. It's actually the point of financial statement analysis people forget about. Financial statement analysis actually leads to more questions than answers. It just does. Okay? So, final piece. I want to go back to McDonald's, and I want to mention two final things about CFI. So back in the lecture note. And I want to focus on two, what I'll call leading indicators of CFI. And I'll try and blow this up to make it a little easier to see. Okay, here's a rule of thumb. Rule of thumb number one, depreciation. Rule of thumb is you need to spend your depreciation to tread water. Like to maintain your current sales, you got to spend depreciation. Otherwise, stuff's going to fall apart. Right? It's not one-to-one because depreciation is kind of arbitrary, but the idea is if I have a 10-year life from an asset, I should be spending about 1/10 of it to maintain it. Okay, that's the assumption. So when companies spend about depreciation, they're kind of in maintenance mode, maintain what you have. When companies spend a lot more than depreciation, they're probably in growth mode. And when they're spending a lot less than depreciation, they're probably not thinking about their growth. So here's the point. I know I told you to focus on the total, but this is McDonald's. Look at 2014, look at McDonald's depreciation, and then look at McDonald's CapEx. And then look at the years around it. Notice anything interesting? Look at the line for CapEx, capital expenditures, and then look at depreciation. Because like I said, if you're not spending depreciation in CapEx, your stuff is going to start to crumble. So there's a huge gap. For 4 years, they spent a lot more CapEx than depreciation. All of a sudden in 2014, they spent a lot less. Why? What does that tell you? What's that a warning sign of? Yeah.
Spend more in the future.
Either they have to spend more in the future, or, so that's one good one, or what's the other one, which is actually what happened at McDonald's? Sales are going to be a problem. I don't need to spend on CapEx if I don't have sales. So I'm telling you, hindsight's 2020, but sitting here in the CFI were the seeds of McDonald's problems. They knew sales were slowing down. They projected sales to slow down. They stopped building stores. It's in their statements. All right, it would have been hard to catch on this in real time, but what I'm telling you is that starting in 15, 16, this is what I said at the beginning of class, this is where McDonald's was like, same store sales are down, people aren't coming to McDonald's, they're going someplace else, we're having all sorts of trouble, they brought out breakfast all day, they're trying to figure out anything they could do to get people to come back to the stores, and they slowed down their stores and they started closing stores because they had too many stores. And you could see that the year before, and that they had slowed down their growth. The other one is look at the trend for reinvestment rate. So I gave you initially the 5-year reinvestment rate, but look at the last 3 years. 49, 34, 11. Is that the reinvestment rate you would expect of a growth company? Put the two together. So what I'm saying is these are potentially leading indicators when we start to go to valuation. Because here's the idea. There's a lag between building stuff and selling stuff. So if I'm building stuff today, I'm ramping up hoping to sell it more later, which means if I'm expecting a lot of growth, I'm probably spending the CapEx now. So that's the thing. When we're doing this analysis, we can kind of get a sense of whether a company's in a growth mode by comparing what is their CapEx to depreciation ratio. And if they're spending a lot more on CapEx than depreciation, they're probably assuming that they're in growth mode. That doesn't guarantee that if you build it, they will come, but we know they're building it, hoping people will come. And when they don't spend anything, either they're compromising their business or they're potentially having challenges. So here's an interesting question. And I'm going to do this one in real time, and I'm not in Bloomberg, so I can't look it up. But is somebody in Bloomberg right now? Look up Kraft Heinz. If you remember, last week, Kraft Heinz or Warren Buffett, who's the largest shareholder of Kraft Heinz, did a $15 billion write-down of Kraft Heinz because Kraft Heinz is having all sorts of trouble. They're the makers of Kraft cheese and all these processed food products that you don't want to eat anymore because people realize it's going to kill you. Right? I'm sorry? You still like them, though? Oh, you like ketchup. Okay. So you like the Heinz part. You may not like the Kraft part. I'm just curious. Go to FA. Go to FA and go to custom. And create a custom. And then just put in depreciation and amortization. And then put in capital expenditures. Tell me how they look.
depreciation is significantly higher than CapEx.
Yeah. So part of the problem that Kraft Heinz has had is that they're having trouble selling their products. And so basically, one of the symptoms of this is underinvestment. And unlike McDonald's, which did it for 1 year, how many years was CapEx below depreciation for Kraft Heinz? And remember, a negative number is actually the amount that's spent. So a negative number isn't necessarily a bad number. It means just it's a formatting in Bloomberg. How many is so how many years is depreciation under CapEx? Or is depreciation about CapEx? Okay, what about last year? Okay. So what I'm just telling you is, this is what I mean by, if you're tracking a company, this is one thing you just pull out of your CFI analysis to see, hey, what's this company doing with its depreciation? If its depreciation is pretty much tracking its CapEx, it doesn't expect to grow. It's going to be a flat company. And a lot of mature companies end up in this situation because I don't really have money to throw at this because there's no opportunity to grow. If I'm underspending my CapEx versus depreciation, it means I'm probably expecting to shrink. Or what I also could be doing is kind of looting the business. I'm basically taking money out of the business to line my pockets rather than investing in the future. And if I'm really expecting the business to grow, I should be driving the CapEx to do it. So these are some rules of thumb. They'll start coming more advanced out of the statements. It's not something I expect you to do for Monday, but something we'll start looking forward to in the second half of the semester. So coming up on your homework assignment, very clear. I'm going to give you a company. All right, the assignment will be posted very shortly. You're going to basically do an ROIC tree walkthrough, and you're going to do a CFI walkthrough. It's going to be 500 minimum words. It's going to be individual. It'll be due Monday at 10. Okay, we'll discuss this in class next week, and we'll also make sure you have Excel ready, start building out the valuation model. Okay, I've just recorded this on YouTube.